You guys have asked for it and we are making it for you. Where are some of the top property experts and investors in Australia planting the seed for the next 2 to 5 years?
It's such a tight rental market at the moment. Because of this, rent is starting to slowly go up.
This episode, we're breaking it down into where each expert sees the strong growth, the stats on the area, zooming straight into the good pockets and the bad pockets, even digging into the downsides about the area long term.
So this is a really good pocket here.
The only real concentration is around. So that's a street just to be mindful of.
And finally, our expert panel unpacking why these suburbs have the highest chance of growth over the next 2 to 5 years.
As a whole, I am confident in it because of its strong population growth and the recovering economy.
First up on the panel, Dawn Fouhy, successful property investor and co-founder of Future-Proof Property Advisory, gives an on-the-ground insight into her location.
I'm queuing to get into houses because the stock on market is 0.27% and is seeing it play out in real time. I love it.
Steve Ash, former investment banker who's built his own $10 million portfolio, unpacks a value play some might see as a little controversial.
This is something to be very mindful of when investing. I'm not sure if I can say this, but I will.
But we also want a property investing mortgage broker's perspective. And for that, we've got Morgan Bushell from Full Circle Finance.
As far as proximity to one of the biggest capital cities and the entry price, you can't really achieve that anywhere else in Australia.
And last but not least, the lead research analyst from InvestorKit, Junge Ma, joins us to unpack an area that the company's entire team is backing for the next 2 to 5 years.
Median house price there is now 532,000. Owner occupying proportion is really high. We just see 28% renters in that area.
So then the $64 million question, why is this on your list for the next 2 to 5 years?
So 3 reasons. First one,
So if you've been searching for areas that have got more medium to long-term growth potential, you're going to enjoy this episode. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode is powered by InvestorKit, Property Strats, Property Developer Network, Full Circle Finance, and Future-Proof Property Advisory. More about our amazing show sponsors in the show notes below. But right now, let's kick things off by chatting with Dawn Fouhy about where she's picking for the next 2 to 5 years. Dawn Fouhy, how you going?
Todd, what is the crack?
There's a lot going on at the moment, or a lot cracking. And I know that you're actually buying quite a lot at the moment, and especially in the area that we're actually going to discuss. So literally putting your money where your mouth is, not for the short-term gain, but for the long-term gain. But there's actually a bit of short-term movement that I know you're wanting to really open up and chat about, which is something that I'm particularly interested in as well. So can we start off with, Dawn, where are we looking at for the next 2 to 5 years as far as that solid longer term growth?
So we're not talking about hotspots. You don't want people to make 200K in 6 months.
It's not the flavour of this episode, no.
I'm only joking. So it's really important, I think, for people to realize that investing is changing, and those affordable markets and perhaps those, juicy yields that were around before, it's a different time. So as you said, we're talking about the 2 to 5 year time horizon. So we are in Melbourne and we are in Frankston.
In Frankston. Okay. Now we're going to get into the why and start really unpacking a lot of the details about Frankston. So far, everyone's talking Victoria. Tell me a little bit more about the stats on Frankston specifically, though.
Okay, so it's important when you're talking about Frankston. So Frankston City is the LGA, and within that LGA, you've got Frankston North, Frankston South, then you've got Seaford, Carrum Downs, Skye, Langwarren and Sandhurst. So Frankston sits in between, I was going to say it's straddled by, and I was like, that probably doesn't sound good. It's bordered by Frankston North and Frankston South, and you've got Frankston smack bang in the centre.
You could even say it's girt by, if you want to start quoting.
Well, it is girt by sea. Well, Bay, Port Phillip Bay. Yeah. It's girthed by that, but we digress.
So tell me about some stats as far as like median house price, yields, vacancy rates, all that kind of fun stuff.
Typical buy price is $735,000. So I guess for your investor looking for a cheaper entry price point to Victoria, it might not be for you, but for an investor who has the, propensity to hold for the long term, like we're talking about, and be able to get equity extraction in the medium term, this is an ideal suburb for you. The yield is about 3.8 to 4%. But what I'm seeing on the ground is really interesting. So when I'm at open homes there, it's first home buyers, second home buyers. I'm queuing to get into houses because the stock on market is 0.27%.
0.27%.
And this is a market that has done like nothing for 3 years.
Can you just timestamp this as well? When are we recording this, Dawn? Or I can do it. I don't know why I'm asking you.
February, because, I can really say February.
Yeah.
February. Yeah.
And 2025. So this isn't something that's happening, ages ago. This is something we're seeing on the ground now.
And that's hot. That's like hotspot data for me, seeing a stock on market like that. Like, that's wild. And then seeing it play out in real time. I love it and I think it's important for people who might not even know what stock on market is. It's easy for us to chat about it all the time, but it's that supply indicator, and it's showing us that there is such a tight level of supply in this suburb. But not only that, we're seeing with the inventory level, the market absorption there is just like, it's like Pac-Man. The stock is just being like gobbled up. So we're at 0.7 months of stock there.
I thought you said Pac-Man at first, but you said Pac-Man, like the...
I said Pac-Man,
yeah, okay.
Yes. Yes, just a little Irishism there.
So 0.7. So, this has got to be one of the most tightly held markets in Melbourne at the moment, everything you're describing.
Yeah, and it's playing out on the ground. So, and then when we look at the days on market, and remember data is old, right? So days on market is 36. So the minute data is printed, it's not real. So what we're seeing on the ground is like there was one house and it sold it was up for auction. It sold before the auction to a first home buyer. It sold after the first home opened. So the days on market was only 8.
8. Okay. Can you start opening up a little bit about Frankston specifically? Because right now you're describing something that's got some pretty hot pressure around it, and kind of ironically, because we're talking at the very start of this, that this isn't a hotspot market. Now we're very much describing a hotspot, but I know we're going to get into a little bit more why the long term. But Frankston, from what I understand, and being an Adelaide boy myself, I've always had the comparison that Frankston is kind of similar to like Christie's Beach, Christie's Downs. There's some good pockets, bad pockets. Like, can you kind of open this up a little bit more and bring some clarity to anyone that doesn't really understand the area?
100%. So we're talking about Frankston proper. So I think Frankston North has more of that reputation. Locally, it's known as the Pines, that area in Frankston North. It has a higher level of social housing. Within Frankston proper, the only real concentration is around Frome Street, Frome. So that's a street just to be mindful of. And again, we can never categorically say that, areas around there won't grow, but it's always just better to do your due diligence.
Absolutely. Okay, so Frome Street, somewhere that maybe isn't the most desirable pocket to be investing in. Where are some of the really good pockets, stuff that people can look at?
I think to really add value to the listeners, I think it would be easy to say, beachfront, Long Beach, great. But I want to tell your guys about an up-and-coming pocket of Frankston that I really like called Coringle. So it's where Sky Road is. So basically with Coringle, it is its own hub within Frankston. Houses on large blocks. You've got Coringle Shopping Centre there, and you've also got a really nice park. When I'm driving around that area, looking at homes, the thing I really like about Frankston proper is how big the blocks are. There's decent side access, really good built homes. But it's important to remember within Frankston, there's pockets within pockets. So Frankston High School zone, Frankston High School is on Foot Street. It's a public school. That if you're in that catchment zone, your house will command 100k more than houses around it. And then you've also got that Coringle area, which is a little bit cheaper, but it's really picking up some steam. The thing as well, Todd, with like the building approvals are only 0.29 as well.
You just said 100K more as soon as you're in the catchment zone for what high school?
Frankston High School zone, and you'll see that on real estate ads as well. So when I talk about a typical price of 736, those homes will sell in the 800s. And it's also good to note as well, there's a 150K price difference between 3-bedroom and 4-bedroom homes for the astute investor out there.
Yeah, or for anyone that's really looking for that value add to see more meat in the sandwich, that's really good to know.
Correct.
100%.
Yes, there's another, we're talking a lot about meat and sandwiches and it's all happening.
I'm genuinely not trying to put all the innuendos in here, but anyway, let's move on. All right, are there any other good pockets or bad pockets that you really want to point out that's that on the ground stuff that people can't see on realestate.com?
I think it was just, I'm actually really surprised every time I go there. So I live like 20 minutes from there. So they had a really big festival there this weekend, the Frankston Foreshore Festival. I think it just gets like a bad name, but I'm seeing more and more first home buyers entering the area because I think I'm hearing a lot of talk around the other areas in Melbourne that are perhaps, lower socioeconomic. Mm-hmm. Those places might be more of a 20-year, gentrification hold. I feel from what I'm seeing, what the data is saying, and just the general socioeconomics of the area, Frankston proper will outperform this market cycle. You have to remember as well, the infrastructure spend going on here. Mm-hmm. Like there's billions going into the hospital redevelopment. Within Frankston itself, you've got a private hospital and a public hospital.
Just in case if someone's looking at this going, I'm liking it. Everything you're talking about, LGA of Frankston sounding good, but maybe 730 at 735 mean house price. It's just that little bit above where they really wanted to go budget wise. Where can they go in the same LGA that's maybe a little bit more affordable?
Frankston North.
Is Carrum Downs the same?
Yes. So you're really putting me on with all of my favorite spots now, Todd. You're really like opening up, the vault. Yes, I do love Carrum Downs as well. So yes, we're very active in Carrum Downs. Frankston North, we're also very active in. So yes, we recently bought a home actually in Frankston North for $650,000, 3-bed, 1-bath on 700 square meters with side access.
All right, so there are some other more affordable options that are in the LGA of Frankston, not maybe in Frankston itself, but pretty close by that can still maybe lean on a lot of this infrastructure spend and everything that's really positive about the area.
Correct. And also, if you have a larger budget and you're an investor that prefers higher socioeconomic area, Frankston South has a median of 1.3 million, and that borders Frankston, which has the typical price of 730. Now, I'll leave all the mathematicians out there to do some sums. And if you want to see a house in Frankston South that's currently advertised for 17 million, check out 26 Gulls Road, because that is a $17 million house in Frankston South.
17 million. I'm assuming this is a very large block of land, a very large house.
Yeah, it's like 360 degrees of the bay or whatever. Like, don't hold me to 360, but whatever it is, 180.
All right. So
yeah, there's always pockets within pockets. The only stock I'm seeing sit in Frankston is if it's overpriced, because people are still not silly. So there is always anomalies to the data as well.
Gotcha. Tell me more about the downsides. What do people really need to be aware of if they're going to park some cash in an area like this longer term?
They need to be aware that it is going to cost them money at this point. But I just want people to put on, hop in the helicopter, put on that 10,000 foot lens and say, okay, I buy something for 730 now. The rent is only 600. But remember that the investment stock is getting taken up by first home buyers. The vacancy rate is dropping. A dropping vacancy rate, more pressure on the rental market, increases in rents. So if you can afford $250 to $300 a week to hold an investment property now, that could potentially double in a shorter time frame than you think, I feel that you cannot go past Melbourne now. Yes, there's a lot of negative rhetoric and land tax, and every state has land tax. The threshold is different here, but that could change at any time. So yeah, just make your investment decisions with all the knowledge that's there for you and to suit your hip pocket.
I like it. So essentially what you're saying it's boiling down to is there's a cost to this potential high growth over the next few years, and that cost is weekly cash flow. You're going to be negative potentially $200 to $300 a week. So if that isn't something that works with your budget, then maybe this isn't quite the play for you. But if it is, then there's some serious upside for capital growth.
Correct, because what's the opportunity cost? Do you continue to buy in a hotspot like Townsville? So yes, you might get more rent, but you've missed out on, probably 60% of the growth. So I guess you have to ask yourself those options. And obviously, depending on your budget, as I'm sure, many other people will go through this podcast, there's always other areas, but we're talking about Frankston particularly now.
Gotcha. And if we can really deep dive into why. Why Frankston? Out of all of the suburbs in Melbourne or all of the suburbs in the country, why is this your play for the next 2 to 5 years, Dawn?
Because supply is the enemy of capital growth, okay? So I really am honing in on infrastructure spend, the low building approval, so there's no threat, and just the demand that's there right now for an area that has a lot more to go.
So you're looking at the demand at the moment, you're looking at the future growth of this, the investment that the government's putting into this, and looking at it going through the lens of there's not going to be enough supply over the next 2 to 5 years, and we're already seeing the pot starting to boil.
Correct. So there's nothing to temper that demand.
I know we're getting towards the pointy end of things, Dawn, but can you open up a little bit about building approval stat? What's the data really saying behind it to support your theory on that there's not going to be enough stock?
The building approval percentage is 0.29%.
And give me a reference point for anyone that's like, I have no idea if that's good or bad.
So if you're looking at an area, let's say, that has like a lot of building approvals, you might look at somewhere in like Melbourne's north, like a Beveridge. So, surrounded by land, but there's like 9% of building approvals.
And people say they're very thirsty for builds out there.
They are. They're so thirsty. They're in need of a baraka. So, they're dehydrated at this point. So yes.
All right,
but obviously, this, as I said, this will only suit a certain type of investor to invest in Frankston. This isn't a blanket, everybody go invest in Frankston. This is just a point of view that it may be something for you to look into.
Love it. I think people might think we had a couple of scotches before this episode, but Dawn,
this is just normal business as usual.
I love this. So we're talking Frankston. We're talking as an LGA, you support it. Selectively about Frankston in isolation. Median house price around $730. We've got a yield of around 3.8 to 4%. I love this, what you're talking about with the school zones, how there's around an extra 100K in that. Staying away from Frome Street as well, if possible. It's not going to be the best pocket there, so it's somewhere to consider if you can buy outside of it. As far as the negativity, we're talking about some cash flow. It's not going to be something that you're going in positive. It's not even going to be somewhere you're going in neutral. It's going to be somewhere you're going to have to support. But over that kind of 2 to 5 year period, which again is the whole flavor of this episode, you're looking at this going, there is not enough stock to keep those prices where they are, both on the rental side of things and on the capital growth side of things. So it might be a little bit of a hit to the hip pocket in the short term, but longer term, you're looking at this through a very healthy lens. Is there anything else you wanted to add to this one, Dawn, before we jump off the call?
No, just hope people found it helpful, and just take action and enjoy investing. It doesn't have to be that scary.
Love it. Dawn Fouhy from Future Proof Property Advisory. Thank you as always for jumping on the show.
Thanks, Todd.
Okay, so we're looking at Frankston, 735,000. Obviously, as Dawn's saying, this is going to be one of the lower yield plays, I'm going to guess, from probably everyone on the panel. But looking at this, as far as the pressure's already starting to build, it's looking like this might not be like a 2 to 5 years play. You're waiting 2 to 5 years for that growth. There looks like there's potential that there's actually some growth really happening there now. And just to timestamp this, so we're recording this in, what is it now, like mid-Feb 25. So, but again, downsides this one, you're looking at some pretty negative cash flow. This is definitely not for everyone to jump into. But looking at the balance now of interest rates, all of the talk is about them coming down. And maybe by the time you listen to this episode in like a week or so after this airs, maybe they already have come down. But if we can start to see some relief in that cash flow and the capital growth play is potentially really what you're looking for, this might be an area worth jumping into in more detail. But right now, let's jump straight back into the panel and chat with Steve Ash, a man who's built a $10 million portfolio and looks at things from a little bit of a different perspective, wearing a former investment banker hat, and how he takes it to property investing. Steve Ash, very happy to have you on the panel, man. How you going?
No, I'm really pumped to be on the panel. It's going to be good. Looking forward, but I'm good. How are you?
I'm very good, mate. Now,
Awesome.
as far as picking a more medium to slightly longer term area, one of the reasons I wanted you on this panel is because, well, not only have you built your own like $10 million portfolio, you kind of got the runs on the board there, but it's a lot of the background with Goldman Sachs, with the investment banking, with Australian Super. Like the way that you look at things is kind of through a different lens. So I was very keen, and I'm sure there's a lot of other people listening, to see where is Steve looking at with that 2 to 5 year lens on. So is there anything you want to kind of set the stage with before we jump straight into the where?
Well, yeah, sure. And I think it's a great question. There's been a lot of looking at short-term plays and where there's going to be growth in the year or so. But being that long-term investor myself, that 3 to 5 year or 2 to 5 year, I should say, is exciting. And I'm just looking at this through the lens of a contrarian style investor as well. So I just wanted to set that scene. So I'm going to talk as a real investor here, where I see Australia and where I see value.
Love it. All right, Steve. So with that in mind, where are we looking?
Okay, so I mean, similar to some of the podcasts we've done before, I clearly see a lot of value in Melbourne at the moment. And to be quite honest, it's a smorgasbord really there of suburbs where I'm pretty sort of split on where we should select, but I'm going to go Sunshine West.
Sunshine West, okay.
Yeah.
And now, for anyone that's not familiar with Sunshine West, tell me a little bit about the stats of the area, median house price, days on market, that kind of stuff.
Well, yeah. Well, I mean, first off, Sunshine West suburb about 13 to 14 Ks west of the CBD, so very close. We're looking at a median price of 675,000 here. So yes, pretty cheap considering that proximity to Melbourne. We've got a 10-year growth play of 5.4%, so not shooting the lights out, but not too bad. Over the last year, we still see prices come up 0.7%. So, it's still pretty flat, and we'll talk about that in a second. Yield's pretty low here, so 3.8% maybe compared to some other Melbourne suburbs. And yeah, days on market 33, so that's been trending down quite a lot. The other sort of stat I like a lot is the owner-occupier rate, which is 71.6. That's extremely strong, so a high percentage of owner-occupiers in the area, which is great. The other thing I wanted to talk is just where kind of like that median price was just in 2021, 2022. So it was around that sort of mid-sevens mark. So we're buying at 100,000 odd discount now, which to me just shows great opportunity in a value play.
Absolutely. So it's not trading like $10, $20,000 under median. Like this is a significant discount from where it was.
It is. And we're going off a fairly low base before then as well. So we've just had this period, and we talked about this a few times on the podcast. So we've had this period of underperformance. In fact, it's around that 7 to 8 years or so in many Melbourne suburbs. And so generally what you do in most assets, when you've got that period of underperformance, you get that period of outperformance. We don't know when that's going to go, but because we're looking at 2 to 5 years, I'd be pretty confident from an investor point of view that we'll see that outperformance come back.
100%, man. Okay. Is there any other stats you want to talk about in the area before we start diving into a bit more of the nitty gritty, good streets, bad streets, that kind of stuff?
Not really. I mean, the school area is maybe not as good as some of the surrounding areas in the LGA of Brimbank. So, we've got Derrimut just to the side and, schools are a little bit better there. But, there's good and bad pockets in Sunshine West. So, yeah, we can have a look at that. But I think those are the main data points I wanted to cover.
All right, easy. So about 100 grand under where it was a few years ago. As far as its growth, it's grown by not even 1%. I think you said was it 0.7?
Yeah, just 0.7.
So 0.7 in the past 12 months, but it's actually come back from where it was 2 years ago by about 100 grand.
Yeah. In fact, there's another metric I've neglected to sort of mention.
Yeah, chuck it in.
Yeah. So it's the vacancy rate. So looking at a very tight vacancy rate of 1.05. So we should... And because the yield's a little bit lower in Sunshine West, we should see a bit of rental growth in that area. And we have seen that rental growth over the last 2 to 3 years.
Because the yields in Melbourne have always historically been pretty low. But
yes.
What are you looking at yield-wise in Sunshine West?
Okay, so the yield we're looking at is 3.8%. So it's a little bit lower than some of the other suburbs that we talked about, your likes of Broadmeadows and some of those other areas. But, there's pockets and there's deals to be had. And I think if you can get a deal, anything over 4%, that'll be good.
All right, so 3.8% yield, which means realistically you can put something together in the fours. But looking at this as a growth play, realistically, as far as yield on purchase is concerned, it sounds like this area's really got a lot of potential to push it up to the 5+ within maybe a next kind of 12, 24 months. Because what was it that you just said before? You said something. It was I can't remember it exactly, but it was about basically when it hadn't performed, it's going to perform. There was a term you used.
Yeah, there'll be outperformance after long periods of underperformance, especially in the bigger metro areas in Australia. And that's generally what we've seen. We saw it obviously in abundance in Perth, a lot of pent up years of no growth, but particularly Brisbane seeing that overperformance for the last few years. And not to go off track, but if we look at, say, Callanga, for example, in Brisbane, the 10-year growth rate is above 7. And that's really just come in the last 3 to 4 years. And so it will come to Melbourne. It's just a question of when.
Mate, I love it. Let's talk about good pockets. Let's talk about bad pockets, because Sunshine West, I know it a bit as well, and it's very pocketed. So I'm very keen to get you to open this up in a little bit more detail, mate.
Yeah, sure. I'm going to ask a favour, Todd, just to help me out and just to sort of, for the people watching on YouTube, it might just be an easier sort of place. So would you allow me to share my screen just quickly?
Yeah, man. I don't know if I have to give permission for that, but go for it. Yep.
Right. So can you see that okay? Just
I can.
Make sure.
Yeah.
Yeah, okay. So we've got this pocket of Sunshine West just here. So really good pockets. And we see this just reflected in the price points, just close to the station up around here. Like you've got Murray Street around here. Some really nice, expensive homes, nice, streets. So this is a really good pocket here. And you can see this overlay. This is actually looking at social housing in the area. So the green, it shows there's no social housing. And while you can make good money in social housing, like just need to sort of have your eyes open when you go in there, and there's considerations. And we'll cover that in a second. But here we can see, no social housing, lots of owner occupiers as we discussed. So good pockets around here to the northwest of Sunshine West.
Is there a couple of street names we can chuck in here if you zoom in just a touch more, just to give us a bit of a reference point for anyone listening as well?
Yeah, sure. So you've got Murray Street here. So anything north of this, Glengala's a bit of a busy road, but anywhere around here is really nice. Nice homes, expensive. As I said, tree-lined streets, etc. So pretty good. And then the closer you get to the station, there's some pockets in there as well. I'd say you'd be paying a bit more of a premium in the upper end towards that medium or just over if you're in these sort of areas.
Absolutely. And Armstrong Street's a bit the same as well. All of a sudden you go down there and it's a beautiful tree-lined street and everything looks quite nice.
Yeah, it is. I'm going to pack up and move from Brizzy back down to Melbourne again. I'm going all over the place. But yeah, no, I like my tree-lined streets. So very nice. And
so as far as the social housing aspect, can you focus a little bit more on where's some of that?
Yeah, sure. So we're looking at the southeast of the suburb. So, I mean, it's a little bit more industrial in this pocket, but there's still some good areas, to the southwest. But if we go over here, and you can see, the big red marker here. So there's 29.5%, 33.3% in this particular area. So that's near the primary school. And if you're talking about streets, I'm not going to pick on any specific streets here, but you've got Talentire Road here. And so we just talked about it. There's opportunity. You'll be able to get houses at a discount to the median and with a bit of value add. But this is kind of, that sort of pocket where you might see the odd sort of mattress on, sort of in the garden, maybe cars parked there, so cars on wheels, etc. But investors, our sort of job is to look through this and look at the value play and see what we can do. So you can make monies in the good areas and the bad areas, but it's something to be mindful of
100%
when you come to this suburb.
Yeah, I've spoken to people that have made very good money in good areas and very good money in, let's just say, below the blue collar. So it really comes down to more risk appetite. Personally, I've made money in both, and I think so have you.
Yeah, no, I have. A classic example is in Perth, getting into those suburbs that have that higher owner occupier rate a little bit nicer. So I'm thinking Naranda, which is slightly north, and sort of made good money there, but similarly sort of in those lower socioeconomic areas and getting a good price with a good yield. There's a place in your portfolio for both. And so the yield just helps grease the engine of the portfolio, allowing you to build more. So this is exactly what we're looking at. If you kind of want to be more of a, set and forget, capital growth play, nice house, you'll do well, but you would sacrifice a bit on yield. But if you want to maybe manufacture that sweat equity, there's pockets there where you can actually really supercharge this if you've got the risk appetite to do it.
100%, man. And so talk to me about the downsides of just, I guess, Sunshine West, Victoria as a whole, because Victoria really seems to be the flavour across everyone in this episode. But I want to hear it from yourself.
I mean, there's obviously a lot of negative news in Victoria. There was heavy migration out of Victoria, sort of around that COVID time, world's longest lockdown, a bit of a stigma there. It's been a pretty aggressive area for landlords to invest in Victoria recently. So there's a couple of things there which really deter There's been the land tax, for example. Everyone knows about that. It could be repealed. We'll just have to see what happens there. But I actually don't think the land tax is a massive deal. I say that to everyone I speak to, because you're kind of like rule of thumb looking about $1,000 per $500,000 worth of land, and the rates are a little bit cheaper in Melbourne. So I don't think that's a bigger one, but I do have a bigger one for you. And this is something to be very mindful of when investing in Victoria, and that is the tenancy standards and the tenancy rules. So if you get an older property, and if you're in one of those areas we just looked at, specifically it's an older house, then generally you just need to budget in a little bit more, because you do have to get electrical and gas compliance works done to make that. It is a little bit more to think about when you go in there. And just very strict tenancy laws in what you need to do. I think it's a good thing, but it's definitely a deterrent for some investors who maybe held assets for a long time, small yields, no capital growth, and then all of a sudden you're slugged with this, and, it just feels like a never ending sort of quagmire of nothingness here, like when you're trying to grow wealth. So yeah.
Well, and if you are looking at buying something thinking, oh, maybe I'll get something with a bit of reno potential, but I'll renovate it in a few years' time. It's like, okay, but you might be doing a bit of an unofficial renovation just to get it up to meet the Victorian minimum rental standards.
Yeah. I know you're a great renovator yourself, Todd. So you know that if you're kind of, putting new carpets and sort of paint and kitchen in, you're actually getting dollars back. But with kind of like what you need to do, where you might need to sort of
switch out
upgrade the switchboard and do the PowerPoints, look at the gas lines, that's not going to give you any sort of sweat equity value. So it's just something that needs to be done, and you need to factor that in.
100%, man. All right, so land tax and minimum rental standards in Victoria. Anything else you want to talk about before we get into the really solid why Sunshine West?
Yeah, I'm in the last one, and I'm sure everyone else has mentioned it who's picked Melbourne, and it's the obvious one, is the yields. So historically, yields in Melbourne have been low, and they are lower compared to other capital cities. What the interesting thing is, they're catching up to some of the areas just because of the massive capital growth we've had, but you do have to factor that into the cash flow play. So if you're looking at, say, 4% yield on whatever purchase you're getting, after tax, that could be 12,000 before tax, over 20,000. So there's quite big holding costs there. There's obviously ways to skin a cat and get around this, but it's definitely, a negative that needs to be discussed.
Yeah, it's certainly no Perth, like smashing a 5.5, 6% yield just straight off the bat, that's for sure.
Yeah, it is. There's obviously a lot of activity in Far North Queensland, for example, but you look at some of those rates and insurance rates up there, and so you might be looking at, say, a 5.5% yield, for example. That net yield comes down pretty quick when you factor those in. So you might be a little bit closer to Melbourne than you think. So, but still,
I reckon we've got to make this as an episode, because you're making a very good point here, and we had someone in the comment section actually point that out, talking about like how bad the yield is, the land tax, all this other stuff. But when you actually sit down and work out like the difference between some of the more Far North Queensland areas where your insurance is huge, your rates are huge, and this is in no way like a deterrent. You've got to invest where it's best for you, but do it based on the actual numbers instead of actually just looking at one extra charge in isolation. What does it look like as a whole? Because you're right, we've got property in Far North Queensland and we pay a lot in insurance, but the yield's still pretty good, but it's not actually that different when you break down everything.
It is. And when you do factor that all in and have a look at that net yield, it would be interesting. I think it would be an interesting, discussion to talk about. It could be another slice for you down the track.
Yeah, 100%, man. Well, as far as the why, I feel like value play is definitely going to be the flavor of your answer, but can you expand on why Sunshine West?
Okay, 100% is that value play. So we discussed the yields, obviously. And so if you are going to take sort of Melbourne on as an investment, and particularly Sunshine West, and you are going to take that low yield, then we're looking for that capital growth play. So the main sort of thesis in my mind, as I said at the start of the chat, like I'm a very contrarian style investor. We know that there's been that little growth over the last 7 to 8 years, just minimum in the area. So again, I'm just thinking there's going to be outperformance at some point, and I'm thinking that's going to happen between that 2 to 5 year period. So I think that's one thing. Proximity to Melbourne is obviously another thing. There's infrastructure sort of works going in the area, so there's a bit of money being spent. So you've got the Metro Link upgrade, you've got the M80 Ring Road upgrade, so it works going in there. But really, it's just looking at just the value. It's just so cheap. One thing I also wanted just to talk about as well, we talked about the median price being 675. You can buy land around the 600 meter square mark, and that's selling for around that sort of 550 to 620 mark. So if you're picking up houses around that 600 to 650, you're getting almost a free house. It's incredible.
And this is what I 100% agree with you on, Steve. I mean, actually, I'm pretty sure I agree with everything you said. But I mean, this to me is just, when you look at it through that lens of you're basically getting a free house, it's almost like it's this little penny drop moment that the rest of the stuff that downsides, because there absolutely are downsides to this, and there are risks that 100% need to be managed. But free house, like it's insane. Try and do this anywhere else in the country.
You just can't. You're well below replacement cost, and we saw it a little bit in some other states, and that sort of like, I call it mean reversion. I mean, it's a classic investment sort of phrase, but value investing is mean reversion. At some point, value will be realised and it will go back to the norm. We've seen that in the other states. We've finally seen that in Perth. We will see it in Melbourne. We just don't know when, but I think it's a pretty good boundary in 5 years. But what is it, 550 square metres, and you're buying it so like around that 550 mark, 600? I mean, that's crazy.
I was saying to someone just yesterday that every now and then we'll get someone that comments like, "Oh, calm down, mate. You just because you bought houses before COVID, like everyone boom, blah blah blah," that kind of thing. And I get it. Like that's to a certain extent that there's some definitely validity to that comment. But I can't help but think that now, recording this in 2025, in 2027, 2028, 2029, whenever it is, we're going to see comments of, "Calm down, mate. Just because you bought in Melbourne in 2025, like it's." I'm personally so confident on this. Whilst there's never any guarantees, the thing that I wanted to ask you though, Steve, is, and I know it's a bit of a crystal ball question, but when are you looking at this really starting to pick up? Are you looking at this as like you're going to be holding this for 2 years and still having flat, or are you looking at this as like, no, things are already starting to move? What's your timing?
It's a tough question. You said crystal balling, but to be quite frank, areas in Melbourne have started to move, and we have started seeing days on market tick down, but and also those prices come up in a few of those areas. Sunshine West has started gradually rising, no matter what the data is saying. There's more owner occupiers that opens, vacancy rates are coming down. So we started to see sort of like some green shoots in certain areas, but again, like my sort of thinking is I just want to get in when it's quiet anyway. Lukewarm, you can get in, buy well, maybe a little bit undervalued, but maybe a bit of sweat equity. But personally, I'd prefer to sort of see it be, stay stagnant for the next year. But I just think, the green shoots have started to, there's a lot more interest. There's what I'm seeing, a bit of migration coming back. As I said, you're seeing those vacancy rates check down, specifically in some areas of Melbourne. And so that means people moving back and interstate migration coming back. So I think it could be flat, or just it will have a decent sort of maybe year. But certainly, I think when it starts hitting in the mainstream media and all of a sudden news.com starts talking about Melbourne prices going up and record auction prices, etc. And that's the other metric. Auction prices have been tracking up this year.
Like so clearance rates?
We're well into, the clearance rate's well into the 60s now. So everything's pointing that way. And then the other thing, I'm not sure if I can say this, but I will. And already there's some sort of interest from interstate investors, but when they all start piling in and they start kind of realising that the prices in Melbourne are as cheap as, say, far north Queensland or Perth, etc., I believe you'll see a lot more activity come in, and when they start coming in, that'll be the real sort of fuel to the fire, and we'll see that explosion. So at the moment, lukewarm market will get in, but those factors I just talked about, when they do come to play, we're going to see Melbourne really start to sort of perform well.
You ever seen that chat? It was actually Simon Sinek's video that like propelled him to fame. We're talking about the golden circle. Seen that?
I haven't, but I'm going to making a note of it.
Mate, it's brilliant, and watch it if you can. It's talking about like why people need to know why they do what they do. But one of the things that he talks about is like the bell curve of like early adopters and innovators, then people that have seen a little bit of success, then they'll start to follow. But then by the time the masses get there, it's like it's starting to go back down. And I feel like we're very much in that start of it, where it's early adopters and innovators going, I think I can see where this is going, but there's still not enough safety in the numbers of like, yes, it's 100% going that way. But then once it starts to get to that point, it's like, well, the masses are in, you've already lost. Like there's a price of that certainty.
Yeah, there is. And I think that's a really good way of putting it. Sort of at the moment is, and I've heard this from a lot of people, it's like, Melbourne, why? Is, the economy's bankrupt, everyone's leaving there. And I'm just hearing about Perth. Perth's just going crazy. But then all of a sudden that rhetoric will change. then when that rhetoric's changed, you might have missed 20, 30% of the move. And so it's a really good sort of analogy you put there, and I'm going to check that out. That sounds good.
All right, Steve. So we're looking at Sunshine West. It's about 13, 14 Ks from the Melbourne CBD. Vacancy rate around 1%. Gross rental yields just a touch under 4. We're looking at 33 days on market, 675 house price, which is about 100 grand under where it used to be. There is some very good own occupancy rates, but there's a few pockets that if you're happy to take on a bit of a higher risk, there is a little bit more of a concentration as far as the government housing is concerned. Again, whilst you can still do well there, something very much to be aware of. So downsides, we're looking at the minimum tenancy standards in Victoria, land tax, lower yields. As far as the why, really, this is wrapped up in a massive value play for you. You can almost buy land for the same price as like house and land in some cases. So you're basically looking at this going, this can't stay this way. Is there anything else I've missed there, mate?
Yeah, no, just on that point, it can't stay that way. To construct a property in that area, like minimum house price, not saying people will do it, but that obviously puts you at 450 to 500 build, up to 1.1 million. That gap will close. So I think you summarized it as always perfectly. In 3 to 5 years, let's have a wrap, and what you just talked about, let's see what the median price is like. I'll be pretty confident it'll be a lot higher than what it is at the moment, though.
Actually, that's a great idea. We should revisit this episode in the 2 to 5 year time frame. I like it.
Yeah.
All right, man. It's Steve Ash from Property Strats. As always, man, it's an absolute pleasure having you on the show.
Thanks for having me, Todd, and have a good day there.
All right, I reckon this is going to be the unofficial Melbourne episode now, but if it is, this is how it's just going to come together. I want to bring this to you guys unfiltered, so you can see where some of the top experts in the country are really putting their money with it. And looking at this, like for Steve, Sunshine West, 13 Ks from town. But you know what the biggest standout is for me? This is personally what I see is that value play. Looking at land, like you're buying 600 square meters of land for $500,000-$600,000, and then you're buying 600 square meters of land with a house on it in some pockets for $500,000-$600,000. Like it is almost like we're saying. It sounds stupid to say it. Like it does. I'm fully aware of how stupid it sounds to say free houses, but like look at the numbers. It's not as stupid when you start breaking it down. But again, being in Victoria, looking at land tax, looking at the minimum rental standards, and some of the minimum rental standards, like a lot of them, when you read through them, it's like, this actually just makes sense, all right? It's not about being a slumlord. No matter what people say, it's about making sure that you're still providing a nice, safe, clean, like a good home for someone to live in. It's why they're renting it from you. Sometimes they can go a little bit overboard, but you just got to make sure you're on top of it. Don't have stuff like this randomly surprise you later on. You're like, what? I've got to replace all of my PowerPoints? Or like maybe it's the air conditioner. And you're like, that air conditioner is only 5 years old. It's like, yeah, but it doesn't actually meet the minimum energy rating. So you need to replace it. Just don't be surprised by it. And by doing your research, understanding what they are, talking to a good PM, you'll be able to work it into the budget and go, yes, this is a deal for me. Or no, actually, wait a sec. I know I'm going to need to spend an extra 10 grand there. I can't pay that price anymore. That's the difference between being a real investor with this and being someone that just blindly shotgun approaches it and buys property. We're not property gamblers here. We are property investors. But now let's unpack this from a little bit more of a mortgage broking perspective with a very solid investment hat on and chat with Morgan Bushell to find out where he's picking for the next 2 to 5 years for solid capital growth. Morgan Bushell, hey, go on, man.
Good, thanks, Todd. How are you going?
Mate, very good. It's always good to see you on a panel episode. And I think this one's going to be extra special because we're talking about that longer term kind of play. We're going to be talking about markets today that are more like that 2 to 5 year kind of growth. And I know recently you've purchased as well. You're looking at the longer term play yourself. I wanted to actually get your take, mate, on where both you're seeing people parking their money a little bit more longer term and your thoughts on where planting the seed over the next 2 to 5 years is potentially going to be the most fruitful. So did you want to jump straight in with where? Where are we talking about, Morgan?
Yeah, so I'm seeing the best opportunity in the Melbourne market at the moment. And that's where I'm seeing quite a few clients as well who are also jumping into that market there as well.
Melbourne. And when you say Melbourne, you are talking about like Melbourne and Greater Melbourne, or are you talking about Victoria, Bendigo, Ballarat, everywhere?
Yeah, so like Greater Melbourne, like closer to the CBD as opposed to like outskirts of Victoria.
Gotcha. Okay. So let's drill down a little bit more on the location. Are you talking west, north, which direction?
Yeah. So I'm specifically talking about the north part of Melbourne when it comes to locations in that CBD area.
Okay. Tell me a little bit more about what it looks like now and get a little bit more specific on where north.
So to be more specific, Todd, the suburbs that I'm kind of interested in where I'm seeing people buying more is in the Broadmeadows area. So there and also surrounding suburbs of that particular area.
Okay. And surrounds what, like Coolaroo, Dallas, that kind of stuff?
Correct. Yeah, like Meadow Heights, like all those sort of pockets around there.
Gotcha. All right. Tell me a little bit more about what those areas are looking like now, both from wearing a broker hat and investor hat.
If I was to put my broker hat on at the moment, comparing to other parts in the country, borrowing capacity is a little bit less just because of how rental income is in comparison to the purchase price. But then as an investor, there are some really big opportunities in that market that I'm seeing, I guess, from a medium to long-term play as well.
What kind of opportunities are you talking about? What development sort of set and forget, renovation? Can you open that up a little bit more?
Yeah, so it's kind of a combo of like set and forget, but also renovation. So to talk more specifically, like the market, as we all kind of know, like Melbourne, Victoria is taking a bit of a beating when it comes to investor activity, but also cash flow wise. So there's no kind of secret with these types of investment properties. There could be potential for like land tax. The rental yields aren't as high compared to other parts of the country.
Mm-hmm.
So if it's something that people, I guess, are willing to kind of live with in that short to medium term, I think they'll really kind of benefit in the medium to long term with these types of properties and locations.
So I was going to ask you a little bit about the downsides a little bit later on, but I feel like we're touching on that now. So if you want to open that up a little bit more, so lower rental yield is definitely one of them. And to put that in perspective for anyone that's a little bit newer, how low is low? What are we talking?
Yeah, I mean, you're kind of seeing around like 4 to maybe 4.5. Like if you're getting up to 4.5, that's really good. But kind of seeing around that 4, maybe lower, depending on, how many like bedrooms there are, what kind of property it is, stuff like that.
And for what you're seeing for the past kind of 6, 12, 24 months, people that have really been expanding their portfolios, and this is more of a broker hat question, what kinds of yields are they typically getting to kind of really make it easier to continue to grow? Is it needing to go to that 5.5, 6.5? How much further up?
Yeah, anywhere from like 5 to 6 is just really going to help you with borrowing capacity as you progress and build your portfolio. So yeah, by contrast, these properties aren't as friendly towards your borrowing capacity, but if you can do it and I guess help buy more, then there is that kind of aspect of growth from medium to long term as well.
Now, you and I were chatting the other day about the difference with yield on purchase and kind of looking a little bit further down the track. And again, the flavor of this whole episode is long-term play. So can you open up a little bit more about what you're kind of predicting and also just the benefits to having a longer-term view on your yield from a broker's perspective as well?
Yeah, definitely. So like this particular market at the moment, rental yield, as I've kind of mentioned, is not super great. However, it's such a tight rental market at the moment that because of this, rent is starting to slowly go up. Even if there's an existing tenant in there, chances are once they vacate or it's renewed, the rent that they are, or the market rent, I should say, is actually higher. So this is something that I've personally seen with a place that I bought recently, but just seeing across the board. So I do believe over the long term, this is just going to become more and more attractive to investors.
And even comparing like places like Adelaide to Melbourne, I feel like similar kinds of locations, it's actually more expensive now to rent in Adelaide or Brisbane even in some cases than it is in Melbourne. I don't think that's ever really happened before. Melbourne and Sydney have always been those more pricier places to live.
Yeah, 100%. And another really good thing about Broadmeadows is it's actually about 17 kilometres from the CBD as well.
So it's pretty close. Like, and this is like we're talking about downsides and pros. I'm sort of mixing up my order here, but this is all good stuff, Morgan. So if we were to talk more about the downsides from Victoria, what are the things that people really need to be aware of, maybe from a land tax component?
Yeah, so once you start acquiring property, there will be an element of land tax. And another layer to this as well is if people are considering purchasing using trusts, the land tax is actually higher in that compared to buying in your personal name too. So the main thing, I suppose, more as an investor is just do your numbers, like make sure your cash flow is something that you can like meet or the portfolio can sustain.
All right, Morgan, what about some of the good parts and the bad parts? Because I know we're probably going to get it in the comment section. Like, have you ever been to Dallas? Have you ever been to Broadmeadows? Like, the answer is yes for me. Pretty sure it's yes for you as well. But there's always good pockets and bad pockets of any area. And every area kind of sits a little bit different as far as like how like affluent it is, or if it's below the blue collar. But it doesn't mean that you can't make money out of it. It doesn't mean that you can't do well out of it. But if you've got the choice to be in a better pocket, well, naturally you want to gravitate towards that. So do you mind unpacking a little bit more on the ground sort of knowledge about Broadmeadows, maybe a bit of where to stay away from, where to steer towards?
Yeah, sure. So if you were to look at Broadmeadows, you can kind of put it into like quarters. So there's Camp Road that kind of goes right through the middle, so from 9 until 3 o'clock. And then you've got Blair, so that goes from 12 until 6. So if you were to kind of look at it in quarters, I would say if you don't want to be too much on the outer edges, so too close to the main roads or like too far north that you're close to Dallas. If anything, you probably want to be like in that, I'd probably say the top left quadrant. So that puts you pretty close to public transport, so the train station. It also puts you just a leap over the motorway to the shopping centre, so that's quite close. And yeah, I think it's okay to also be in that kind of left bottom quadrant as well, because you're also relatively close to those amenities, but it can be like there's also quieter pockets in there too. So a couple of names to give you guys, for example, is like Cuthbert Street or Jacana Avenue. Both of these I feel have good smaller streets branching off them that are quite quiet. But what I really like about them is for the demographic of the area, so bigger families, it's closer to schools, but also it's closer to public transport again as well.
Gotcha. And it's like that close, but not too close. You don't want to be facing the train line, but it's nice to be sort of 5-minute, 10-minute walk away.
That's it. Correct.
Got it, man. All right. So as far as the downsides, we've got lower rental yields. We've got some pretty high land taxes, and there's a whole bunch of other political stuff we're not even touching the sides of that's really happening in Victoria at the moment. And as far as the good pockets in Broadmeadows right now, you're saying around Jacana Avenue, Cuthbert Street, just for a couple of examples. Really, it's about being close to amenities, but not too close. Not pushing over towards that Dallas side of things, but it's more about just really staying in those nice little pockets that I guess offer what you want. So as far as what it looks like now, it's not looking super attractive. Like we just said, the yields aren't that great. I think the market has actually still gone down at the point of recording now. I don't think nothing's really going up leaps and bounds. And when you're now comparing Perth doing something like 20% last year, I think Adelaide doing 14% rather. Got that the other way around. And then you're looking at Melbourne, I think it like went backwards something like 2%. It doesn't look exciting right now. But again, more to your point that this is why it's about planting that seed longer term. Can you unpack a little bit more about why you really feel Broadmeadows, I guess Melbourne as a whole, but Broadmeadows more specifically, is the place to be for the next 2 to 5 years?
Yeah, I just feel that as far as proximity to one of the biggest capital cities in the country and the entry price that you can get at, you can't really achieve that anywhere else in Australia. And yes, like there are the downsides like we kind of gone through, but the opportunity is that it's appealing to people that really can't afford to buy closer to the CBD. So they're kind of getting pushed out. So for me as a medium to long-term investor in this scenario, I see that as a great opportunity to really kind of ride that wave up just because it's been depressed for so long as a market.
Are you getting a little bit of like Blacktown, Campbelltown vibes 2014? Like just that kind of everyone's going, you crazy, what are you doing? And then all of a sudden the fuse is lit.
Yeah, it feels a lot like that, especially like Cabra, because I followed that market around that time. And yeah, like in hindsight, wish I bought there, but it has a similar vibe to it. So I agree.
Yeah, I very much wish I bought there as well. 2014, I was still just getting drunk all the time. I wasn't thinking about property. But the people that have, and a lot of the people that come on the show are people that did invest there, have done tremendously well there. And I can't help but think that a lot of the interviews we're going to be doing in 26, 27, 28 are possibly going to be the people that are looking at Melbourne right now. So recapping on all this, mate, you're basically looking at this, if I can put it in a nutshell, is it's a real value play. You're kind of saying that considering what it is, where it is, and the city that it's close to, this is it can't stay at this price.
Correct. Yeah, that's exactly why.
Got it. Morgan, is there anything else that you wanted to add on to this one, mate?
I kind of mentioned it before, but I guess the main takeaway for anyone who's listening to this is this market, it's cash flow wise, it's not great. So really just make sure you do your numbers because, yeah, if you add too many of these portfolio quite quickly, it can really affect cash flow and potentially, lifestyle and whatnot. So just the main takeaway is do your numbers.
Got it. And I think something that we always say on the channel is how is this one going to help you get the next one? So if you're doing your numbers just on this one, probably not the way to go. If you're doing it on how it's going to get the next one, like you're saying, Morgan, that's going to help you expand. But Morgan Bushell from Full Circle Finance, it's always a pleasure to have you on the show, mate. Thanks again.
Thanks, Todd. Thanks for having me.
So yeah, I think it's pretty safe to say this is the Melbourne episode. So again, as far as downsides are concerned, it's consistent. Rental yields are a little bit lower. Land tax is obviously not great. But again, proximity to the CBD, you're talking around that kind of Meadow Heights, like Dallas, Broadmeadows kind of area. You're pretty close to the CBD. We're still looking, what is that, like 16, 17, 18 Ks, like again, depending on exactly where you are. And looking at, again, still being able to pick things up in the 5s and the 6s and rental yields in the 4s, manufactured rental yields sometimes are going into the 5s and above. I can see why this is Morgan's pick because there's definitely some good pockets and some bad pockets to be aware of. And more so also things like being close enough to the train line, but not so close that you're literally next to the train line. You want to walk to it. You don't want to hear it every 10 minutes. But getting something with that high potential for some more rental growth for a really decent buy-in price, again, Morgan's mortgage broking hat on, this is going to be one of the things that does actually help as far as that capital growth, increasing your equity to potentially be able to go again, but also having some good yield to it so your cash flow is nice and strong, which I mean, cash flow is not amazing right now in Victoria, but just check it out. Like look at Melbourne and like as a renter, right? Put your renting hat on and start looking around at everything in the areas that Dawn said, that Steve said, that Morgan said so far, and then compare it to the equivalent in Brisbane, in Adelaide. Like I saw a place the other day in Sunshine West and it was in the 300s per week. I think it was $390 per week. There is no way you are getting that in Adelaide. And that's Adelaide. Melbourne and Sydney have always been tied together. Adelaide was always like the tag along that everyone was like, whatever. And now Adelaide is beating it. This doesn't make sense. And logically, it's staying that way. It's not a fit. So I look at something like what Morgan's saying now, and it's like, absolutely, while the cash flow isn't amazing now, how long is it going to stay like that? But let's go to our final panelist, last but certainly not least, Junge Ma, lead research analyst from InvestorKit, and find out where all of their data is pointing them towards the next 2 to 5 years. Junge Ma, how you going?
All good. How are you?
Very good, thank you. Very glad that you're on this panel. I'm sure there's going to be a lot of people that actually agree with me on this one as well, that we're keen to see where you guys are looking at with a wider lens of 2 to 5 years. But before we jump into exactly the where and pulling everything apart, is there anything you wanted to set the stage with at all, Jung?
Not really. Just do it.
Done. Let's jump straight into the core of it then. Where are we looking at for the next 2 to 5 years through the lens of Junge Ma?
I am looking at Bendigo, the regional Victorian city.
Bendigo, okay. And we're going to jump a little bit deeper into exactly what area as well, aren't we? But for now, like we're looking high level Bendigo.
We can actually, as we are talking about suburbs, I just picked one suburb as an example, and that suburb is Kangaroo Flat in the south.
Okay, Kangaroo Flat. And talk to me about what it looks like now.
So median house price there is now 532,000.
Got it. Yeah, that's well below. All right, 532. So what kind of area is Kangaroo Flat? Is this more like blue collar? Is this kind of mid-level? I'm assuming it's not blue chip for 532 as a median.
It's not blue chip. Yeah, it's kind of a blue collar area. According to the census data here, laborers take 17% of the residents. That's higher than Victoria average. And then other big residence groups are community workers, technicians, treaties. And then professionals are 15% of the residents, and that's lower than Victoria's average.
Gotcha.
So I guess it's safe to say blue collar area.
Blue collar area. Got it. Okay. What else can you tell me about Kangaroo Flat?
It is also a family area. Lots of families are living there. Owner-occupying proportion is really high. We just see 28% renters in that area.
So that's pretty low. For anyone that's not understanding the renter to owner occ ratio, 28% is pretty good, yeah?
Yes, it's lower than average, but at the same time, not extremely low that it's hard to get tenants.
Got it. Could you actually just open that up a little bit for anyone kind of wondering why? Like, because there is a balancing point, exactly like you're touching on there, where if it's too high, it can kind of swing the other way and there's too much stock. But if it's too low, it's like, well, then it might be tricky in the other direction. Do you mind kind of unpacking that a bit?
In my suburb reviews previously, I was seeing suburbs with 6, 7, 9% rental property proportion. That is extremely low. Those areas are usually either very expensive or very rural with farmlands. Those areas, I don't think renters would like to live in those type of areas.
Got it. And then if it's the other extreme and it's like 90% renters, then it's like there could be a glut of stock.
Yeah, even if it's only 50 or 55%, it's high enough to create lots of competition between landlords. And then it will be a bit hard for you to, one, get tenants and two, raise your rents.
Okay, so 28% for Kangaroo Flats, sitting sort of nicely somewhere in the middle.
Yes,
Got it.
I do like that number.
Okay, perfect. Anything else you want to talk about as far as what it looks like now before we get into like bad parts, good parts, like sort of pulling apart the suburb a little bit more?
Yes. I would like to talk about its inventory level because it's not really high, even though the growth recently is not really good, just 4.3% year on year. Its inventory level is now just 2.6 months of stock.
2.6.
So quite low.
Yeah, okay. And especially right now for a suburb in Victoria, that's pretty low, isn't it?
Yes. And it's actually never been really high. I remember it should be 3 point something back in 2023 when prices were declining. So this low level of inventory or low level of supply, I think it's good because once demand is back up, it'll be very easy for the price pressure to go up again.
Gotcha. Okay, so 2.6. And final question on inventory here. Is it staying stable? Is it trending downwards, upwards? Like what direction is it going in?
Yeah, right. Good question. It's been trending downward since mid-2024. So it's been half a year now going down.
Got it. Okay, perfect. All right, so inventory trending downwards, low percentage of renters. We're talking a pretty good 532,000 as far as median house price is concerned. So what I'm hearing there, this is still possible to purchase something in the fours, which that almost feels unheard of now. What about the yield? What's the holding cost for a place in Kangaroo Flat?
You're right. Rental yield is actually healthy in Kangaroo Flat, 4.7%.
So 4.7%, again, that's like the average. So finding something you could potentially put together with a 5 in front of it doesn't sound out of this world at all.
I don't think so. If you, for example, do some rentals, you can easily increase your rent.
Fantastic. All right. So as far as how it looks now, this is painting the picture of an area so far that's got some affordability to it. Maybe even some reno potential. It's got some good demographics as far as like renter percentages. Inventory's trending in the right way. Yields are pretty decent. Victoria as a whole has got its own problems, which we'll get to downsides, which I know a lot of people will probably beat us up for in the comments section, but let's get to that soon. Can we start talking about a few of the good pockets, maybe some of the bad pockets? What are people needing to really understand on more of a detailed level for Kangaroo Flat?
Let's talk about the back pockets maybe, and that should be easier.
Sure.
Yeah, if you go to the map and check Kangaroo Flat, you see one major highway in the middle of Kangaroo Flat. That should be called Midland Highway or Calder Highway or High Street. Depending on which parts you're checking.
Depending on which part of the map. I know what you're talking about. Yep.
Yeah. But you can easily see this really, really wide highway in the middle. I would say you better avoid properties facing this highway directly.
Got it. So for you, this isn't so much about a bad spot, good spot. This is more so about something that's realistically a bad thing to be near, no matter which suburb you're in. Like you never want to be right on the edge of a highway.
Right. It's not going to really affect growth. The concern is more about rentability. Usually when you are directly facing a highway or very close to a highway, you may face longer vacancy period because it's not as attractive to tenants as properties in those quieter areas.
Totally. And totally makes sense as well. And not all highways or thoroughfares, main roads are obviously created equal. Some you've got semis going down and it's like proper noisy. Others are just a little bit of a thoroughfare. But if you can stay away from all of them, the quieter the place is that you're in, the better it's going to be, the more attractive it's going to be. And so what are the downsides that people need to be aware of here, Jung? What's the stuff that people are going to blast us for in the comments to say, hey, this is bad. This is the stuff you need to be aware of?
When it comes to Victoria, it might be the relatively higher holding cost because of the land tax. That could be one of the downsides. And the second downside could be the slow short-term growth. Bendigo, as a city, it is at a relatively early stage of its growth cycle. So in the coming 1 or even 2 years, growth could be below average. So we better be prepared for that.
So can I ask then, if the short-term growth side of things isn't really looking that good, obviously this is the whole flavor of the episode. You're picking where the next 2 to 5 year play is really looking strong. How not short-term is not short-term? You're expecting this to maybe move in the next 6 months, 12 months, 24 months? Is there any kind of an indicator, or is it still too early for that even?
Short term, for me, it's 6 months to 12 months. At this time, we are just seeing signs of pressure picking up, but really it's not high enough to achieve a really high growth yet.
Gotcha. So it's still very much in the early adopter phase, but not in the full risky early adopter phase. It sounds like it's just kind of moving through there.
Right.
Got it. Okay. So I feel like you're kind of almost getting into a little bit of the why for it, because our downsides, low rental yields equals high holding costs, land tax, Victoria loves a good tax. As far as short-term growth, it's probably not going to be there. There's some markets right now that you can buy in that you're pretty much you're off to the races as soon as you purchase. And older houses. So if you're a renovator like me, then amazing. But if you're not, you're looking for set and forget, you might be searching for a little bit more. Is there any other downsides we need to move on to before we unpack the 2 to 5 year? Like, why has this really made the list for you?
Yeah, no more downsides for it. I actually like the suburb.
Perfect. So then the $64 million question, why is this on your list for the next 2 to 5 years, Jung?
Right. So 3 reasons. First one, Victoria as a whole, I am confident in it because of its strong population growth and the recovering economy.
Yep. So strong population growth, recovering economy. But you're talking Vic as a whole now, not just like Bendigo. Got it.
Yeah, it's more about Victoria. And then the second thing, we go down to Bendigo. The local economy is actually strong. The unemployment rate here is 3.7%, and that is lower than Melbourne or Victoria's average.
Gotcha.
Also, it's GRP. The local GDP is growing faster than Victoria's average as well. Last year's real GRP growth was 2.6%, while Victoria's average was 1.5%. So
almost doubling
as a city, So as a city, Bendigo is doing really well economically.
Okay, so number 1, Victoria as a whole, strong population growth, strengthening economy. Number 2, we're looking at something that's got locally quite a strong economy. Both its unemployment rate's down, its GRP is almost double that of the state. What's number 3 on the list for us here?
The third is more about the cycle position. Bendigo as a whole, as an SA3 or a city, its last 10-year growth, if we annualized it, it was only 5.6%. That is actually lower than the national average. So from that, we can tell it's actually in an early stage of its current growth cycle or the coming growth cycle. And within Bendigo, although different suburbs have a different last 10-year growth, but they essentially are very similar to each other. For example, this Kangaroo Flat, the annualized growth was 5.9%, slightly higher, but still lower than average.
Can I ask this? So this is basically a big value play on Victoria. So it's like it's coming backwards. Even Bendigo, like you're saying, or the 10-year average of 5.6, was that statewide or was that Victoria-wide? Sorry, that's the same thing. Was that statewide or was that Bendigo-wide?
Yeah, that is Bendigo White.
That's Bendigo. Okay, because this is what I just wanted to ask here as well, because a lot of the time you'll hear people talking about Melbourne. Like when it starts to go, it's generally Melbourne that goes first, and then it kind of trickles out to Bendigo, to Ballarat, to Geelong. Is that something that's just a little bit of a like whispers next to the water cooler, or is there evidence to actually say, no, that is generally how it works? So one of the signs people need to look for is once Melbourne starts to go first?
I actually checked their last 10-year, 20-year growth yesterday. Geelong follows Melbourne quite well. 1 year Melbourne booms, the next year Geelong, we can see at least a very strong growth. But when it comes to Bendigo, Ballarat, they actually don't really follow Melbourne's trends very well. They kind of have their own cycles.
So as far as people looking at Melbourne and going, okay, Melbourne's done now it's time, like as far as an indicator's concerned, the data disagrees with that. Unless you're looking at Geelong, then maybe there's some ties.
Right, yeah. Just don't use Melbourne as an indicator for these farther regional cities.
Gotcha. And so finally then, Jung, why Kangaroo Flat? I'm understanding Bendigo, but out of all the areas that you could have picked in there, all the suburbs, why Kangaroo Flat?
Kangaroo Flat, it's more about the affordability and healthier yield. Its median price now is lower than Bendigo's median. Bendigo is 550,000 now. Kangaroo Flat is even lower than that. And Kangaroo Flat's yield is actually higher than Bendigo's. Bendigo's now around 4.5%. So higher affordability, a better yield, and in this high interest rates environment, it's naturally more attractive to both investors and owner occupiers.
Got it. So anything you can do to really make your cash flow healthier, make your purchase cost lower, your buy-in price lower. Also, if you are wanting to add a bit of value, have more upside for potential value add as well. Everything's kind of coming up Millhouse. Is there anything else that you wanted to add to this one, Jung?
No, I think that's everything I have. Now.
Love it. Junge Ma, lead research analyst at InvestorKit. It's always a pleasure having you on the show.
It's my honor. Thank you so much.
So Bendigo, we're looking at a 532 median house price, blue collar area, inventory levels at 2.6. But this is the thing I like, 532 as a median. So you can potentially still get into this area in the 400,000s, which just doesn't seem doable anymore. Here, it is. So if you've got a budget in the mid to high fours, and I do want to caveat this with, if you're getting something in the fours, you might need to roll up your sleeves a little bit, or you might need to get a few like carpet curtains, paint, some very light cosmetic stuff done. Or on the other side of things, if you're really getting it in the low fours, you're probably going to need to get some proper renovation works done. And if that's what you're into, certainly what I'm into, you can make some amazing returns on it when it's done correctly. But if it's not, then you're probably still looking more around those low, mid, potentially even higher fives. But even then, the rental yield with the medians here is still 4.7%. That's off the bat. Remember everything we were talking before about rental growth potentially when it kicks in, and you're not looking at the yield on value in a year, 2 years time, you're looking on the yield on purchase. These start to turn into some very healthy yields if that does happen. And signs are pointing towards that there's a pretty strong possibility. Downsides, no surprises, land tax, and potentially looking at a bit more of a weight on the short-term growth side of things. But again, the whole flavor of this episode isn't what's happening in the next kind of like 6 months, 12 months. The flavor of this episode is, where are you planting the seed longer term? This isn't chucking veggies in a garden to come out in a few months. This is planting the apple tree. It's going to take some time, but is it going to have much better yields when it's done correctly? I hope you guys have enjoyed this episode. You're wanting more stuff like this, like comment below. Let me know. I'm not trying to rhyme. That's just how I go. Okay, that was bad. But let me know what you want more of. If you're wanting more areas pulled apart, drop a comment of where. You're wanting more panel episodes like this? Like this episode was born from you guys. It was our top 25 episode. People were like, yeah, cool. This is all well and good like for the first like 12 months, but what's long-term looking like? I was like, that's a great idea. I sit down. It's pretty much how I start most of my days, is like sitting down, just reading the comments and chatting with you guys. And I love it. And if you haven't subscribed to the show yet, make sure you hit that subscribe button so you do not miss an episode. We are absolutely turning up the volume this year in 2025 with the quality we're bringing you, and the information is only going to get better and better. My name's Todd Sloan, and this is the Pizza and Property Podcast. I'll see you on another episode.